All right. Good morning, everybody. TGIF. So we're nearing the end of the last full week of the year. Everything from here on out will be shortened weeks. Lower volume can participate in very outsized moves, so just keep that in mind. China's up more than 2.5% this morning. That often leads us towards emerging market trades. The China ADR list from the KWeb constituent, BABA, Baidu, JD, PDD. We'll review those before we're done this morning. Then we've got the Russell right behind that, and often that would also lump in stocks from the NYSE. So keep your eye on the $ TICK today for more divergence like we had yesterday. All right, if you remember looking at the tick yesterday, it stayed mostly in the green through the morning, and yet we were selling off in the indexes. That was due to Russell or NYSE. NASDAQ up a little more than a quarter. Same thing with the blue chips and then the S&P behind them. Japan down just a little bit. Not that bad. Certainly something to keep our eye on after the news that came through. Looking at Market Watch, I go to this place because this is one of those places that only likes to highlight the biggest events of the day. And if they don't deem the event big enough, you'll get what we had on Monday, nothing scheduled. There was events on Monday worth keeping an eye on, but according to this place, nothing that they cared about, right? So when we go to these different places, and I'm going to show you a few that I use every day, their goal is different, and that's why you see different events listed. For Market Watch, they really only want to highlight the biggest events, and only in America. They don't focus on events that are happening in other nations. So this is my quick piece, right? My hit piece. I come over here, I can just take a glance. What's the biggest thing that I need to be worried about today? 8:30, 9:15, those two time frames with Empire State Manufacturing and industrial production capacity utilization. Okay, so says Market Watch. Now you bring it over to FX Street, and you don't need an account at any of these places. All right, so sure, if you sign up for something, you would have more access to things, but you don't need that access. You just need these time frames. So FX Street, if you do want to sign up and get a free account here, be very careful about what email you give them because they will bomb you with nonstop emails. So, it's nice to have at least the free account so it'll remember your settings, but it sucks to get all of those emails, right? It's borderline spam. So if you have a real account here, you plan on paying and using their services, it's fantastic. No argument for me. But with that free account, they are relentless with that emails. FX Street has this impact gauge. This is useful for newer traders who don't necessarily know what events they need to be concerned about and which ones they don't. This isn't perfect. It's looking at historic records and asking, does this particular event have a history of being volatile? Well, that doesn't mean that something is going to be volatile this time. And even if it has been a sleeper on average, it doesn't mean that it couldn't be volatile this time. So it's a gauge giving you some historical precedent, but it's not perfect. It's not going to tell you that this time is going to be violent or not. But you can set it to your own time zone. I found that really helpful for newer traders as well, especially you California people who are constantly asking me, is that California time? No, it's not. Nobody trades with California time. We're all trading the American stock market, which is in New York, right? So you trade the New York time frame. So if you're someone who's still struggling with time frames, you can set this clock to your time frame, and then you'll know when these events are. Finance Juice is my go-to every day for an aggregate news service. These guys are collecting news from all over the place, and you can use the filter to eliminate the news sources that you don't want. For an example, I don't really care what Fox News has to say, CNN Business, MSNBC, right? I don't need that trash, so I turn it off. You do need an account to be able to turn off the things that you don't want, but it doesn't cost you anything to get that account. You can have a free account and have control of the filter. So that's good. But as a paid account, it's definitely worth it. It has this live squawk, and the pro news will come out before anything is even written. And there's a lot of things that they announce on voice that never get written, which is it's fantastic. It's a great heads up. It also has this tick strike. Even the free version, just turn that on, and when flows are coming in, you'll hear it. Now, you know, the free version is slightly delayed, but still, it's a great heads up. So I just keep it up all day long. One of the reasons I like this is if we get speakers today that weren't necessarily scheduled 6 months ago, you know, newer scheduled speakers will show up on this list, and they won't necessarily show up on other websites that I was showing you. So, you know, if you get Yellen out chipping her teeth, you'll know it on this website. Or if Christine Lagarde is suddenly going to be speaking tomorrow, it would show up on this website. So that's kind of the go-to. Let's get the spot gamma levels. I have to sign in. Hold on. While we're waiting for spot gamma. 8:15, 8:30, 9:15, 9:45, and 1 o'clock. Although I got to say the 1 o'clock rig count, look, most of the time, if there's anything wrong with those rigs and the rig count was going to significantly change, you would have already heard about it, right? If they had to do a recall on the rigs, shut a new fleet down, something like that, it already would have made news. So that number can change, but it usually is just a 1 to 2 rig change, and that's about it. Now that we're exporters of energy, we don't really see a significant change in the rig count. But say back in the 07, 08 crisis, when people were losing their jobs and it was finding it harder and harder to work, every week we saw that rig count getting lower and lower and lower, and it sucked. All right, spot gamma levels. Here's the S&P and the ES through the SPX or the ES. And really the four that you want to capture is the call wall, the volatility trigger, zero gamma, and the put wall. Don't get me wrong, those other levels, the combos and large gamma, they are relevant, but the critical ones are those four. Just capture this with a screenshot, and that way you can take your time drawing them out on the chart. Here's the SPY. I use a program to take pictures called Snagit. It's what just popped up here. It's just a little hotkey. This is fantastic. You can preset all of your colors, your settings, even use something like a timestamp so that you'll know exactly what time the picture was taken, and it's all automatically saved. You don't have to do anything extra to get it to save. This is perfect for journaling your trades. It does video too, but it's for another day. All right, it's been a fantastic run. And depending on how you want to validate the pivot points, then we've had missed daily pivots all the way up. Tuesday is a little bit of a user-defined You know, if it wasn't for the volatility, we would have never tagged that. So, you know, some people aren't going to count that. Even if we just set that one aside, we had an MDP Wednesday, Thursday, and so far today, depending on if you want to count that open or not, then we had it today. I'm not counting this as an MDP personally, a missed daily pivot, just because when we open like this right at that pivot point, to me, that has weight to it. So it's always a little bit of a hit and miss on the way you want to do your analysis. As I mentioned yesterday, when we start the day already at one of the ADR levels, we have the capacity to go to the other side and hit the other ADR level down here. This is just a function of time, really. But these ADR levels, if we remove all of the nerdy scientific stuff out of it and just talk about it in plain English, it's the average daily range. Think about what that stands for, the average daily movement of a stock market. So over the last 20 days, what has the S&P done? It's hit these lines. It's gone this far. So what's our expectations for today? That it would go this far. And in fact, it already has. Well, if it makes that move on average in a 24-hour trading cycle, and we're already there, and in fact, we've been there, you know, in the first 12 hours, well, now what are we going to do? Sure, we could continue and get to the other line, pushing through that call wall at 4,800, or we could retrace back to the other side. If you use this indicator on something like TradingView, you can see the past days. You can look back and see how often we hit the edge. And you would be probably pleasantly surprised by how often we hit those red lines. We still cannot use the market maker move. It's still broken because of the triple witching. How do we know? Well, we can come in and we can check. It's still showing this one, so we'll just scratch on that, let that one go. We've got today's, which is the, it's showing the AM settled here. And we can look at these and gauge whether the front end is bigger than the back end. And if it is, then we don't have a true market maker move. This has been fighting us all week. So next week when we come in, we'll be done with it, and we'll be able to just look at the optionality on the side and check and see, you know, is the front end higher than the back end or not? And that hedging has a lot of value to us, right? It lets us know with that market maker move, if they're scared of something, they're coming in and putting a lot of insurance on their trade in the front end. It's a great heads up. We just haven't had much of it this week, right? Because of the being broken, you can't trust that the market maker move is real. 10-day, 30-minute volume profile. We've got a very shallow area below our own low of yesterday. And in fact, it's more of like the Globex low of yesterday. If we break that, then smooth shot, we could make it all the way back down to 4,700 relatively easy. You can see how it's very shallow here, right? We can drop through shallow areas very fast. I do want to point out this pivot here at 4,750. There's nothing here, right? So why did we turn? This used to drive me crazy as a newer trader. What did we hit? We hit something, right? Obviously, we something. And I would go hunting for that, trying to find what did we hit. Sometimes I could find it and sometimes I couldn't. Now, later in life, I understand that the ES necessarily didn't hit something at that low yesterday. Something else might have hit something. So say the DXY, the Dixie, the dollar index, was running to the upside while this was falling, and the dollar hit resistance and fell back. And in that fall back, the S&P started moving higher. Right? Now, is that what happened? I don't think so, no. But it's an example of how the S&P could turn like this and go the other way without ever having hit a support level or anything, a moving average, a pivot point. All right. So when you see this, when you find the market has turned and there's nothing here, trying to figure out like, what the heck did we hit? Try to look at the other markets, the 10-year, the dollar, bonds. Look around and see, well, what was moving the S&P in the first place? Because what is moving the markets isn't always the market that you're trading, right? Which is why I continue to say, I don't care what you trade. You want to trade Facebook? Great, trade Facebook. Try to find other companies that are like Facebook to also watch them while you're trading it. If you're trading Bank of America, watch Wells Fargo and JP Morgan, right? Price is king. Price is everything. That's what you've heard, right? Price is the best indicator you can use. Great. So looking at other prices is going to be the most valuable resource you could put your hands on. We are still inside day. Quite a nice recovery, no less, but we are still inside day. And right now we're working on pure price method with failure building in. If we were to go to a higher time frame, this high that failed to get above this high is a lower high. Dun, da, da, da. Pure price method, when we set this pivot down here, and we've now set this pivot here, we are setting up for failure. Now, it can change its mind, but when you've got a market, it's moving to the upside and it sets that high and it fails to get the equal high, this becomes relevant. Breaking through that would be trigger one, and then coming up and getting that next lower high and breaking that one. So on this 5-minute, that doesn't really hold true, right? But if we were to go to a higher time frame, a 2-hour, even a daily, then this setup is starting to shine through. You can see where most of the volume is. We've got a really wide Globex, and yet all the volume is contained in the upper part. We've spent the greatest amount of time right here. Or let's say that, yeah, that's the right way to say it. Here in blue is the TPO. It's not a volume profile as much as it looks like one. It's time, price, opportunity. Consider that volume by time, whereas the other one is volume by price. So greatest amount of volume by time is right here. We didn't spend a whole lot of time there. Or excuse me, we didn't get a whole lot of volume there, but it's where the TPO is, right? So this divergence here kind of implies with this breakdown that we're getting, that could be where the unfinished business lies, and it's where we're going back to first. I tend to use these two in a pair. TPO by itself really is is missing the other half of the story. And the same thing with the volume profile by itself without TPO feels like I've only got half the story. Now you could turn on a monkey bar chart, but that's going to be set to 30-minute time frames, and then it uses those letters, right? And it just is confusing for a lot of traders. But the monkey bar chart would have both of these together, and it would give you more of that teardrop shape, right? Because you'd have the volume profile on the left and the TPO on the right, and it would, yeah. It's interesting to note that after this run that we've had, the point of control is right up here at the top. What you'll notice a lot of times is the greatest amount of volume in a move will either be at the top of the candle or at the bottom of the candle. And sure, on this 5-minute, talking about a particular candle might not make much sense. But if we bring it back to a 60-minute chart or even a daily chart, we look at that high and ask, where's the greatest amount of volume? Up here. Well, okay, what does that imply? We hit a ceiling. It also, by the way, lined up with the ADR. Isn't that nice how all of our pivots line up? Bonds are down 2.5%. Bitcoin is down 2%. And healthcare is down. All right, well, I got to say bonds look better than stock does right now, right? Bonds came up, tested against that high, just like the S&P came up and tested against that high. The difference is the S&P has already pulled back significantly from that, and bonds have just started in this rally-based drop setup. Nice liquidity zone there. Should we come back and retest that? The 10-year is pulled back significantly from the high of the Globex, but it's still resting above yesterday's low. So if we're looking for, a continuation rally today in the S&P and the NASDAQ, we really want to see this 10-year break structure and head to the downside. On the other side of that, we can see that the Dixie continues to press new highs. So we had our Globex high here, and then here, we're also getting these higher lows. So sure, the dollar is down compared to, say, earlier in the week, but it is trying to build a little bit of a base. It is trying to turn around and head back up. So that's a divergence between what we've got on the 10-year and what we got on the dollar. We want to see if this divergence gets resolved, right? What we're looking for is that the 10-year is going to start to rise, and we'll have both of these rising up at the same time, and or that the dollar flips and comes back down and starts testing that low, and we get a breakdown below 101.75. Can you imagine the dollar below $2, solidly below $2 by the end of the week, by the end of the day today? That's pretty bullish for the markets, even if we are down a little bit today, right? And consider the fact that, okay, we're down a little bit today, but look at the move we've had this week. Yeah. So we're back to a daily chart on the ES. We've got our weekly expected move. And we're outside the range of a 2 standard deviation. Although, in reality, it's not a true, real 2 standard deviation. But this is the range for the week that we normally focus on right there. And you can see how much greater the move was than what it was supposed to be. And we already have the projections for next week. Now, these aren't set in stone yet. It's still live. It's still moving. We generally use a static expected move. It's fixed. It doesn't change. But on Fridays, it's not set yet until 4:15 tonight. This box is going to continue to move. You might not see a box, but it's this box, right? It's the current price of the market. It's the measured move high and the measured move low. And as the ES moves up and down, these lines are going to move up and down until 4:15, and then they'll lock in place. So one of the things that we're looking for on Fridays is the new week range equal to, bigger, or less than the range that we currently are in? And remember, this week that we're in is the last full week of the year. So this week that I'm measuring, next week's range, it has 1 day less than this week. You wouldn't notice by the size of that box. So there's a lot of volatility next week. How do we know? Well, because it only has 4 days, right? We measure the move by how much volatility there is. In those 4 days, the volatility is equal to and or greater than the volatility of this 5-day week that we just had, an FOMC week, a PPI, and a CPI week. You know how much volatility there was in this week that we just had? And next week's is equal to that. And there's only 4 days next week. So we want to approach with a little bit of caution, right? One of the things that we have as a generic takeaway is that when volatility is elevated, the cost of your options are more expensive. That's just the way it is, right? Like inflation. Milk, $8 a gallon. I know, right? It's nuts. Now, this range could shrink through the day, and by 4:15 tonight, it could be much lower than it is here. Could be, but this is what we've got at the moment. Also, we're supposed to close inside the range 8 out of 10 weeks. And we had 3 weeks in a row where we did close inside the box. We're almost due for a breakout. Now, I don't like to approach it from that way, like it owes us one, right? Oh, well, we haven't closed outside the range for 3 weeks, so I guess it owes us a breakout this week. That's a bad approach. It just doesn't sit well. But it does make sense that after closing in the box 3 weeks in a row, that we do finally get a breakout week. Not that it owed us one, but the fact that we're getting one isn't much of a surprise. So when you're looking at this and you're thinking, could we actually close inside the box? Even though we're way up here, making it back down here? I mean, sure, we could. We could lose 80 points today, no problem. But what would the catalyst be? It can't just be OpEx, right? That's not going to be enough. We would need an actual trigger that would put us down there. Some macro event, right? And there's just nothing that big on the table. Maybe something comes out of Europe that rattles the markets before they close today. Could be. Other than that, if we get through the morning session without, fire bombs, then, we take that off the table. It's more likely we go to 4,800. As crazy as that sounds, right? That we get up there and we hit 4,808. Oh yeah, we're way past the 5-bar rule at this point. This is a 9 grid of the sectors. The top 3 are what we call risk on. The bottom 3 are risk off. The 3 in the middle are our midline. If we're going to have a rally day, we need at least 2 of those top grid. And if it's bearish day or a bearish outlook, then we expect the lower ones to kind of light up a bit, because that's more of our defensive sectors. I added the labels for a 5-day change just to kind of show that, the rising tide scenario is in effect. It's not the question of growth versus value or tech versus, staples. It's, hey, what's been going up, tech or staples? And the answer is yes. Everything's been going up. There's some laggards in staples. For an example, we're only at 1%. I'm giving a little to get there, but 1%. Everything else is at 2.5 to 4.5%. So a broad market rally in everything out there. And it's getting a little extreme in some of these. We're getting a little bit of a blow off top, stretched a wee bit too much. Just remember, we can stay irrational longer than you can stay solvent. Don't short it just because you think we've gone far enough that we're owed a pullback. We are at 5.45%, almost 5.5% above the 10-week. And we can see that, sure, we've been at these levels before. We've even been higher than these levels before, but not very often. We're due a pause. A pause isn't a bearish implication. It's just not a bullish implication, right? So we can quit going up. That doesn't mean we're going down. Keep that in mind, right? It's important to hold the distinction between that. And we're more than 1.5% above the 10-day. And as you can see, we've been higher than that before, and we're actually on our way back down. We're moving back towards the 10. Now, that doesn't mean price is going towards the 10. It could mean price is holding still and the 10 is coming up to us. I'm going to be initiating some call shorts, whether it's going to be in the ES with just an ES call naked. I usually approach this with cost, but it's a pretty simple process. You look at the ES, for an example, at our current location, and you start pricing some options, 5,200, 5,400, 5,600. And you ask the question, hey, you think we can go to 5,200? The follow-up to that would be between now and what? January 3rd? No. No, I don't think we're going to 5,200 between now and January. Great. Well, then we can sell a call at the 5,200 strike. It's how easy that was. So we just come in, pick the first January contract, look out of the money and see if there's enough profit there to make it worth our while. If there's not, then we come in a little bit. So here's 52. Well, yeah, there's no money out there. We want to come in some, but just like that, right? So how much money do we want? Well, let's look at the 5,000 strike. You think we're going to go to 5,000 in the next 18 days? Maybe, but will we close above it? This trade wouldn't make very much. Max profit $25 because we're still just not close enough yet. It can be done in the ES, it can be done in the MES, either way. What I wouldn't do at this point is sell a put, because if we do get a pullback, it's going to run you over, right? You can't get far enough away. So you sell calls into violent moves upward, and you sell puts after a good move to the downside, right? Not the other way around. Oil is another one we were pricing in yesterday. Oil micros are MCL, so you can sell options on oil futures. If this floor is in around that 64, 68, then selling some puts here makes sense. If you don't want to mess with the futures, you could use something like USO or take that approach. Gold as a short makes sense with US dollar Japan acting the way that it is. It hit support, right? It hit that 200. So if this does bounce, gold's going to drop. The thing is, if it doesn't bounce, if this rejection continues, then it's going to be a nice move in gold and silver to the upside. Remember, the trade was FXY long off of this low on the idea that US dollar Japan was going to top out, get rejected, be defended, right? And that's working out really well. So if we're expecting US dollar Japan to continue that fall, then gold long. The thing is, US dollar Japan hit the 200 period moving average, so we're expecting a little bit of a bounce at this point. I'm on a weekly, so swap it back. We hit the 200, we bounced, and now we're down to the 300 or the 4. I think it's the 3. The uptrend is broken either way. So long gold, long silver. Yeah, the China ADRs. So I mentioned the China ADRs this morning. China was up, right? You can see BABA for an example in the pre-market, how much it's up. Now, BABA's a gappy bugger, all right? It's got a history of gapping up and dropping down. It's also, if you look at it compared to its peers, it's had a pretty rough go, right? You see this significant move to the downside. But we do have the China ADRs up this morning, and that does include BABA. And Baidu. You can see this significant gap up and breakout outside of yesterday's zone already. PDD. Now, PDD certainly looks a lot better than BABA, right? BABA was down at the bottom of the chart. PDD had that earnings, big gap up, and it kept it. It's digested this big move without giving any of it back. All of the moving averages have moved up in support. Now, that's not to say that this can't dump, but that kind of behavior is exactly what we want to see out of something after it made a big move. If it was going to keep it, it would look like this. If it was going to give it all back, it would have by now. So I say that. Pure price method also says that. See the pivot here and the lower high. That was a concern. We broke that pivot and went lower, more of a concern. But then we rallied up above that high right there. So that broke the downward trajectory. And then we got new highs from this pivot or higher above it, and then higher again yesterday. So we're keeping it at the moment, and we're getting all these flows on the KWeb constituents and the China moves in the overnight. Then there's JD. Big reversals in the last 2 days, but bigger picture, still got a lot of work to do if we're going to turn this thing around. That's some serious bottom fishing, right? Earnings weren't really all that spectacular. It's why it gave it back, but it didn't get new lows. The lows that were set before earnings still hold. From a swing trade point of view, this is not done going down. We don't have enough information to suggest that we've got the turnaround. But from a day trade perspective, we got all 4 of these: BABA, Baidu, JD, PDD. Um, when it comes to oil stocks, like the ones you mentioned, XOM, Oxy, they're not necessarily, quote, oil stocks by themselves, right? A lot of those companies also have nat gas, they have solar energy, it's a basket of stuff that they do. So you could look at one of those names and compare it with the commodity chart itself, the just straight up crude, which is what this is, the WTI crude. And if the name that you mentioned has a chart similar to this, then you could do that, right? But check first. Take this name or take your WTI and match it with whatever name that is on your list and see if it has a similar chart. Just like if you wanted to trade Apple and you look at XLK and you say, oh, wow, hey, look, XLK and Apple are very, very similar chart. Maybe I'll just trade XLK. So if you wanted to trade, quote, crude, and you want to add oil stocks, just make sure that those oil stocks look like the crude ETF and you're good. You're gold. I would say they look pretty similar, huh? XOM and XOP. Yeah. But don't assume that, right? Always check first. So KWeb is up this morning, and that's why we're looking at those China ADRs. Solar is also up this morning, and so are pot stocks. We've got gold, FXI, which is China, more building materials. Building materials has been lit up. It's been fantastic. They're up again this morning. And then crude, oil and gas exploration, IWM, even airlines are close. They're not quite there. Semiconductors, not enough yet, but they're working in the right direction. But with Bitcoin down, we're going to expect the proxies to also be down. So Riot, Mara, Hut, Hive, Coin, MSTR, we expect all of those to be down. Unless we can get a reversal out of Bitcoin, we're not going to get anything out of those either. And then bonds. Well, you know what? We should have stayed there. I mean, bonds look pretty good. They're certainly not done, but they're going to need to pull back and digest this move a little bit. It's got a lot of work to do. You can see how we're in all of this resistance. We're going to have to work that out. Very likely around $100 for TLT. So we're almost there. One more dollar, maybe $1.50 in an overshoot gets us into that next trend line. But I mean, we're really close. We'll get there, digest it a little bit. You can see it on the MACD. We're just starting to get that cross on the monthly. So, we're looking at like 2024 as the year to start turning this around and coming back the other direction. But it's got a lot of work. So a pretty good rising tide this morning. It's moving in the right direction. We just need these to hold the line, right? That's kind of the biggest takeaway, is that these things need to hold the line into the end of the week. Now we could sell off some. It's been a fantastic week. So even coming down into 46.50, that would actually be bullish, right? It would be healthy to do that. Yeah. If we break that 4,700 in the SPX today, we're very likely going to make it back to 46.50 really fast. So 46.76 would be the next level. But the main thing we need to do is keep above that 46.76. We need to keep that. So we could fade back a bit today. We need to keep above that level, that 50%. 46.75 for an easy number to remember. Otherwise, watch the clock, have a good weekend, and I will see you all next week.